Have you ever seen a great company fall so far that people begin to wonder if it's broken for good? That's exactly what happened with Novo Nordisk, ticker symbol NVO. I recently bought shares, and in this video I want to explain why. Not because I'm pushing a particular stock, but as an example of how I think as an active investor, how I look for value, how I manage uncertainty, and most importantly, how I decide when to sell. Because buying a stock is easy, managing one is harder. I'm James Harrington. I spent more than 30 years in risk management, and investing has many of the same challenges. You're dealing with uncertainty, incomplete information, changing conditions, and emotional reactions. That's why process matters. A quick request, please give this video a like and consider subscribing if you like these topics. So, why has the stock been falling? Novo Nordisk has been under heavy pressure. Competition in the weight loss drug space has intensified. Investors began asking an important question. Were the company's best days behind it? And when markets begin to doubt the future, prices can fall fast. That's exactly what happened. But here's what I noticed. The stock price fell sharply while the business still appeared fundamentally strong. I bought shares on March 3rd, 2026 at $36.37. My reason was simple. I believe the market became too pessimistic. This is still a global pharmaceutical company with a long operating history, strong finances, meaningful earnings, a dividend, and a business beyond one single product. Yet the market was valuing it at a much lower multiple than normal. That gets my attention because sometimes a falling stock is a warning and sometimes it's an opportunity. The challenge is knowing the difference. Is Novo Nordisk a value stock or a value trap? That's the real question. A cheap stock is not automatically a bargain. Sometimes stocks are cheap for a reason. So, why do I believe this may be a value buy instead? 3 reasons. First, earnings power. The company remains highly profitable. Second, financial strength. Debt appears manageable and the balance sheet remains solid. Third, the market mood. When fear becomes excessive, price can disconnect from value, often dramatically. Before the recent weight loss boom, this company already had a long history of steady growth. Today, the market seems focused almost entirely on weight loss competition. I believe it may be undervaluing the rest of the business. And I've seen this many times over the years. If markets were always perfectly efficient, bargains would never exist. My experience says they do. And here's the important part. I could be wrong. And this is why active investing is not for everyone. Because owning individual stocks requires research, patience, emotional control, ongoing monitoring, and the ability to admit mistakes. Many people are better served by passive investing. Owning broad index funds and moving on with life is often an excellent strategy. Now, I do both. Passive and active investing need not be enemies. Now, when would I sell? This is where many investors struggle. They know how to buy, but they don't know how to exit. So I use a checklist. For this position, I would reevaluate or sell if I saw dividend deterioration. Now, this could be a cut or it could be deteriorating cash flow. Second would be ethical problems, mismanagement, fraud, or serious integrity concerns. Third would be a broken business thesis. If the company became overly dependent on one area and lost diversification, that creates a single point of failure. And fourth, extreme overvaluation. If price rises sharply beyond reasonable value, risk changes. At that point, I'd reassess. Now, one of the hardest parts of investing is doing nothing. Sometimes the winning move is simply sitting on your hands when emotion wants action. In risk management, we don't fix what isn't broken. In investing, that often means focusing on the company, not the daily stock price. Price volatility is normal. This is an important point. I wait to buy a stock until it hits my price range, but I don't sell unless something significant occurs based on my sell checklist. Investors focus on business performance, traders focus on price action. Two different scoreboards. So, no investment comes with guarantees, but you can improve your odds. Do the work, be patient, buy with discipline, know why you own it, and know in advance what would make you sell it. That preparation is often the real edge, because in investing, discipline matters more than prediction. If you enjoyed this video, please give it a like and consider subscribing. Thanks for watching.